There is a big change coming for the international banking rules, and it is called Basel III. Never heard of it? Let me explain why I am paying attention to it and how it relates to our largest holding, gold. Basel III is a set of international rules created to make banks safer and prevent another financial crisis like the one in 2008. It was developed by global regulators to ensure that banks are better prepared for tough times and less likely to take risks that could hurt the economy. Overall, Basel III is about making banks more stable and trustworthy, which helps protect everyone's savings and keeps the financial system running smoothly. Basel III regulations are slated to be fully implemented in the United States starting July the 1st, 2025, and will redefine gold's role in global finance by reclassifying allocated physical gold as a Tier 1 asset with 0% risk, weighting equivalent to cash and government bonds. This shift marks a pivotal moment for institutional and individual investors, with implications for portfolio strategy and market dynamics. Let me highlight the key changes under Basel III. Physical gold status will be elevated. Physical gold transitions from a Tier 3 asset to Tier 1 asset. This eliminates capital reserves previously required against holdings. Banks will hold physical gold at 100% market value, freeing capital for other uses. It marginalizes paper gold holdings. Unallocated gold becomes a Tier 3 asset, requiring banks to hold 85% capital buffers against exposures. This disincentivizes speculative paper gold trading, potentially reducing liquidity in derivatives markets. Central bank demand has surged in recent years. Central banks in China, India, and Poland have accelerated gold acquisition since 2019, partly driven by Basel III's risk-weighting advantages. Gold's Tier 1 status reinforces its role as a hedge against sovereign debt risks and currency instability. Market implications should be very beneficial to our holdings. First, price support. Institutional demand for physical gold is expected to rise as banks optimize balance sheets, creating upward pressure on prices. Second, physical versus paper divergence. Physical gold may decouple from paper markets, reducing synthetic supply's influence on pricing. This is also why we hold a specific allocation into physical gold and not futures contracts. There are some volatility risks. Daily mark-to-market valuation rules could increase short-term price swings, though long-term stability may improve. My strategic considerations for your holdings are simple. Prioritize physical exposure. Allocated gold gains structural advantages over paper instruments. I will continue to monitor policy timing. U.S. adoption in 2025 may trigger pre-compliance buying by large banks. Basel III represents a paradigm shift, aligning global finance with gold's historical monetary role, while curtailing speculative paper markets. For investors, this underscores the importance of tangible, unencumbered gold in a diversified portfolio. If you are new here, welcome. If you're interested in a personalized review of your current investment allocation, I'd be happy to assist, and please do not take the mindset of, well, it is too late now. It is never too late to take corrective action. Please feel free to reach out and I'll schedule a time that works for you to discuss how we can optimize your portfolio. Happy Easter.